All right, welcome everyone. Hi, this is Clint Coons with Anderson Business Advisors and Law Group. And today I'm here with Albert Bowie, and he is a loan broker extraordinaire. And we've been talking about ways to help real estate investors actually get money from banks, how to outsmart the banks, how to put together a loan package, how to deal with banks so that you can actually get after the money. Because one of the things I run into a lot with investors is, Clint, I have all these properties and I'm having a hard time doing cash out refis, or I'm having a hard time, talking to the banks in such a manner that I can get my loan through underwriting. In fact, this is a problem that I run into as well with my own loans. I was just struggling to get a commercial loan before I met Albert on a property I purchased 2 months ago. And it was really frustrating. I felt that the underwriters were there to prevent the loan from going through, that they weren't going to help me close on this property. And it was quite frustrating because it wasn't for that much money. It was a couple $100,000. It was something I could have actually paid for in cash. And I had the financials to back everything up, but it felt like they were trying to work against me rather than help put this deal together. So what I'd want to do is, introduce Albert. Albert, you want to say a little bit about yourself and what you do?
Sure. My name is Albert Bowie. I'm a mortgage planner over at New American Funding. I graduated from Cal Poly Pomona back in California. I'm originally from Orange County, and I started investing in Pierce County in Washington and ended up moving there. So I've been enjoying investing since 2012, and I'm actively originating mortgages as a loan officer, which is my day job. And I've ended up helping a lot of investors through accountants and through attorneys. And I ended up realizing that it's been very difficult to get a loan when you're self-employed or a real estate investor. So it's something I've specialized in as my personal niche.
And you work in 2 states, right?
Currently, I do. I work in California, Washington, and Texas and Tennessee.
Oh, 4. Wow. So you're bouncing around doing a lot. All right. Well, one of the things I want to start off with is transferring properties into business entities. A lot of what we do is help individuals take their rental properties and put them into limited liability companies for asset protection. And an issue that always comes up is this concern about the banks accelerating the note, because when I go out there and I get a mortgage, of course, it's going to be in my own name. And then I don't want to hold that property in my own name for too long, because if a tenant slips and falls, they're going to turn around and sue me. Mm-hmm. So I, in turn, want to put that property into an LLC. But the catch is it's encumbered by debt. So one solution that we've used here for several years at Anderson is to put the property into a land trust so that it masks the fact that we're actually moving the property into an LLC. So a lender who is looking at the loan will not notice that the property's been put into the LLC because all they see is the trust. Well, what about putting the property directly into the LLC and foregoing the land trust? Because I have some clients that they're just not comfortable using a land trust. And what I'd like to do is get your perspective on, the due on sale clause and how that might come up. And what have you seen as far as lenders accelerate notes?
That's a great question, Clint. What I've seen and what I've gotten from the general counsel for New American was that as long as the note is performing for at least 6 months is generally what they want to see. If you transfer it into an LLC, there will be no due on sale pulled. So that's what my general consensus I've gotten is, and from the prior banks that I was at. So I've never seen the due on sale called in my time, at least. So.
Yeah. Do you think with rising interest rates, though, that banks may be incentivized to call mortgages due?
I think they might from that perspective, but the thing is with you have a performing note, you don't the foreclosure process and calling that note is a lot more of a headache, I believe, than the margin difference in the rate.
And moving it up. Yeah. The only times I've seen it come up myself is when loans have been packaged and they've been sold, and the potential, well, actually they haven't sold them yet, but the purchaser is just doing a spot check, and they've noticed that a few of the properties were not in the borrower's name, and they rejected those from the overall pool that they were buying. And then the lender got upset, of course, because they couldn't offload these. But you know, that's kind of my general feeling as well, that generally speaking, that they don't necessarily go out hunting people to accelerate their notes because they want performing notes. They look better from the bank's perspective, from financial balance sheet. All right. So, you know, if you were going to go out there and you're thinking about obtaining financing, and this is another question that came in this week. One of my clients was looking to purchase a property in an LLC, and the lender asked them for 3 months of bank statements. And he didn't have any money in the LLC that he was going to be buying it in. He had it in a different limited liability company. So his question was, you know, what do I do? And then it came back to, Clint, if I'm considering buying a property, what are some steps I should be taking now in anticipation of going out there and obtaining a loan?
That's a perfect question that happens a lot with real estate investors and self-employed. Recently, Fannie Mae has changed their guidelines. In the past, business funds were not able to be used as reserves, and reserves are generally required when you have rental properties. You might need 2 to 6 months per property, and that's principal, interest, taxes, and insurance. But they've recently changed it as of March. So as long as you can control the entity's accounts, you can use the funds as reserves, which is important if you're shifting money around from entity to entity and trying to purchase properties with multiple entities that you control.
Will they make you take title in the name of the money that the entity that has the reserves, or will they still allow you to take title in any entity you want as long as you can prove you have those funds available in one of the accounts?
With conventional financing, it can only be taken in your personal name or a living trust or non-revocable.
Okay. Yeah, because one thing I ran into problems with was REO properties. When we were putting in offers on REO properties, the bank required that we close in the name of the entity we put the offer in, or the entity we wrote the earnest money check from.
Correct. Yeah, I've seen that once before. Somebody had it in their LLC, and then they realized the bank wanted them to close it in the LLC. So they, at the last minute, they had to use hard money because they couldn't qualify for conventional. Can't close it in LLC. So
okay. All right. Well, that's good. You know, along these same lines, when we're talking about LLCs and income and qualifying for loans, you know, one of the strategies we teach real estate investors is to pay a management fee. Set up a corporation, upstream income to your corporation is a payment of a management fee, and from there they can expense it out through various tax measures and paying for things that ordinarily may not be deductible to them if they're doing it in their own name. But if I'm understanding what we were talking about earlier, that can be a problem if you're applying for a loan.
That's correct. I've seen that a couple times where people will charge their own properties a management fee that will go to an entity, and they use the entity income to pay for benefits that wouldn't necessarily be deductible in their personal name. So like, I think medical, is that right, Clint?
Yep.
Yeah, but those costs will actually be considered a cash loss because if you claim them, you got to get hit with them. So just plan accordingly, have enough income, because if you claim that, it will decrease your qualifying income.
Yeah, so what I'm hearing is that if we're paying too much in a management fee, then you show, of course, less income, which is the qualifying income you're going to need to apply for a loan, especially if you have mortgages on the property, because they're going to look at the mortgages and look at the income that's coming in.
Right.
And if they show negative based beyond the management fee, that could probably hurt.
Yeah, there are a couple of things you can add back, though, that don't actually count against the negative. So, for instance, it could be negative 500. But if a cost called depreciation, which is a non-cash loss, is 600, and we add that back, you'll look like you're a positive $100. So that's a way where you can show positive income, even though it looks negative on the tax return.
Because of the depreciation.
Correct.
So how many people have you worked with that have engaged in cost segregation analysis? In fact, why don't you maybe tell the listeners what a cost segregation analysis is and how it can help them?
A cost segregation, from my experience that I've seen, has only been used by usually people with a significant amount of assets or larger buildings where it makes sense. And what it is typically a residential property is depreciated over 27.5 years. So there's only a portion you can depreciate per year. It's fixed over that 27.5 years. What cost segregation does is it breaks up the components in the building, and reduces them to quicker lives. So it depreciates faster. You can write off more of your depreciation quicker in the initial years where it's the most important for your investment.
So you can get the larger tax deductions, but it's still not going to hurt you on an income side when you're going out and applying for a loan, because that's all going to be added back in.
Correct.
So I could look like I make no money on my 1040, but
Right.
in reality, I have all this cash that's coming in. It's just not taxable
Correct.
income, and it won't affect my ability to qualify for a loan because you add all that depreciation.
Right. I've typically seen it with assets who want to shield their income, have the ability to qualify, but at the same time pay the least amount of tax possible legally.
Okay, great. You know, we have a lot of investors, and I've worked with these individuals who like to put together lease options. And, you know, it's a great way for people to get their renter, their lessee, into a property that they have. Gives them time to build their credit up, is one reason why they engage in the lease option strategy. But with Dodd-Frank, it became a bit of a problem for investors. And that is with Dodd-Frank, as you know, and we were talking about, that if you engage in a lease option and it appears to be an actual purchase by either having part of typically the option payment go towards the down payment on the property, that could be a problem for investors. And so we're often faced with, well, how do we work around it? And how do we put something together where someone at the end can qualify for financing? And given the fact that we haven't been crediting them back their payments for the down payment like we would normally do before Dodd-Frank, how do we come up with that, or structure some deal where they can still go out there and get financing and purchase that property? So my question to you is, what about this scenario? And this is something I've been talking to many clients about, is how about if we structure the lease option where no money is credited towards the purchase, but we reduce the price the client or the lessee is going to buy the property at? So maybe typically you would sell it to them for $250,000 and credit $300 a month towards the final price. But in this case, we reduce the price down to $235,000 is what they can buy it for, and give them no credit. If I did that, and then at the end of the option period, the lessee wants to buy the property, and they don't have enough money for a down payment to go into and acquire a loan through a traditional lender, because, you know, of course, they just don't have it there, even though the equity's in the property. What about if I entered into an installment sale with them where I sold them the property myself? And there's built-in equity of, let's say, 25, 30%. And so I put together a loan with them, a fully amortizing loan, Dodd-Frank compliant, 20-year loan, and I'm going to put it at 10% interest because I want, well, I can't go that high.
Qualified mortgage, right?
Yeah. I'm going to go at 9%, 8.5%, 9%, because I want them out of the property as soon as possible. And that may even be a little high. What could you do in that situation?
And it really depends, Clint, on the amount of payments they've made during the lease period. So would you say that they've made less than 12 months or
2 years?
2 years. After 12 months, in that case, the $335, their purchase price, would be able to be refinanced. It would be considered a refinance if they were to execute that purchase and move forward with it. So as long as there's enough equity, you said 20 to 25%, it would be a straight refinance with no mortgage insurance, since there's more than 20% equity. And I mean, I'm assuming they're an owner occupant.
Correct, owner occupant.
Okay. So no mortgage insurance, and all they would need would be closing costs, unless there was some kind of credit involved in that.
How about if we built the closing costs into the purchase price?
They could do that as well. So they could, they could build it in. So that could be no money out of pocket, just the money during the lease term. As long as they have qualifying credit and income, they would qualify. Now, the downside is if they only pay less than 12 months, it's considered a purchase based off of the purchase price. You can't use the market value. So that's a load of information. But what that really means is you have to go off the $335, and they got to bring in a certain amount of down payment. So the strategy would be to make them have a minimum payment on that lease of at least 12 months, and then to execute the purchase after. That way, it'll be considered a normal refinance, and it will be based on market value at the time, not the purchase value. So that's the key in it. And it also gives the borrower time to set up their finances, their credit, to make sure they get approved.
Okay, now what happens in the situation where we're contemplating it, selling to the individual, but I'm a little concerned about their ability to go out and get financing. Maybe they won't do it, but they still want to buy it. But I don't want to give up title. What other options do we have to do that?
There's other things that I've seen, such as land contracts.
Okay.
Why
don't you explain what a land contract is? Because this just came up again this week.
Yeah, from what I worked with investors, a land contract is in essence a contract for deed or land contract in which there's agreement for payment, and then eventually after the agreement's fulfilled, the agreeer would purchase the property, but no title will be transferred during that interim period.
Okay. Yeah, so with the land contracts, I still hold on to title, and from what I've handled in the past, it would seem that as long as, the benefit to the seller, of course, under a land contract, A, hold on to title, but B, if they default within a year, you can just take back the property and you don't have to go through a normal foreclosure action as you would if you go beyond a year. So it's real advantageous. But how does that work as far as refinancing for the individual homeowner? If I entered into a land contract with you, for instance, and you'd been paying on it for 6 months, could you go in and get refinancing right away?
That's a great one, Clint. So it's similar to a lease and an option to buy, where if you have less than 12 months of payments, it's considered a purchase and you'll be using the purchase price. So if the maximum loan amount is, let's say 95% of purchase price, that means that if you execute under 12 months, the buyer would have to bring in a minimum 5% down. So there's some down payment required. So you may want to check the person's assets and income before going into a land contract. Make sure that, maybe in month 5, they can still buy you out, or month 12, you're based off of market value. So you may not need any money at all to close.
Okay. Yeah. So I'm seeing there's other options here then for people who like to use lease options. They could set that option together and then roll that into a land contract possibly for a year, and then allow the individual to come in and refi it out.
That's correct.
All right. Now you said, 5%. Let's say I'm dealing in a neighborhood where people don't necessarily have the 5% down, and I just want to sell them a property. Are there any programs out there right now where homeowners can get into houses with 0 down?
There are. I mean, for the state of Washington in particular, there's a Washington Housing Finance Committee. They have a product for 4% down payment assistance. You can couple that product with a conventional loan for a primary occupant, which can go as low as 3% down. This 4% down payment, in essence, helps you put 0 down. So you could purchase with literally 0% down as a primary occupant. There are income requirements in varying for different counties as well. And there's also an FHA program with 0% down for primary occupants as well. So if you're a fix and flipper and you need to figure out who you can sell the property to, these programs might be great to unload the property.
So the FHA programs, what are they typically looking for? Who qualifies?
On the FHA program for 0% down, there is an income limit, and it is, I believe, $82,000 for our county in Pierce here. And what that means is both borrowers cannot make more than $82,000, all under the same household. It's still a 3.5% down payment FHA program, but the caveat is that the Housing Finance Committee will grant the 3.5%. So the borrower doesn't have to bring any money in except for closing. So closing could be handled by either seller credit, or maybe the agent wants to provide a credit. So those are some other ways to handle somebody with very little money down and still qualify.
Interesting. So when you said $82,000, so you could have a husband and wife each pulling in $79,000 and they would qualify, or is it household income?
Household together.
Household income together. Okay. All right. So there are options out there. Now, if I wanted to find out, it sounds like there's state and federal programs that come to bear. Is it, so you work in several states, you just said, Texas, Tennessee, California and Washington. Are these programs statewide in Texas, California, and Tennessee as well?
Yes, the 0% down FHA program, it does run a multitude of states. And there are and in every state it's different. Some states it only considers the borrower's income. So oftentimes in Orange County, I see people with too much income. Let's say both couples make 80,000. So that's over the 82 limit. The limit's actually 103 in Orange County. But so what I'll do is I can take the borrower off, because some of Orange County's programs only count the borrower's income.
Meaning you take the spouse off?
Yes, you can take it off.
Okay.
The program in Washington considers household income, so there's no way you can take it off, because they'll know you're there.
Yeah, they look at the household rather than the borrower. So
Right.
you said borrower, but what you meant is that you would take off one spouse
Correct.
and just use the borrower's income who's applying for the loan.
Just one, yeah.
And then title, then is it taken just in the borrower's name?
Correct. You have to have just one.
Just one person on there. Okay, good. Something else that I've looked at before is when you run into a real estate investor and they have multiple properties. Let's say I had 6 properties. Can I do a cash out refi on if I have 6 residential properties? Am I able to do that?
Yeah, there are a couple ways you can do it. One, the traditional route is you can go to a community bank, which has no limits, because conventional loans on a non-owner property, they will not let you cash out if you have more than 4 financed properties. So there are a couple ways around it that I've seen, and one is community banks who have no limit. They can cash out your property based on different metrics, generally commercial type underwriting guidelines. The second one is if the property is in a legal entity, like a corporation, an S or a C corporation, you can purchase the property from your entity as an option to cash out the property. The proceeds would go to your entity. So in essence, it would be a workaround method to get a cash out, since you control the entity as well.
So you're saying that, give you a hypothetical. So I have S Corp or LLC set up, and it owns a property. And I want to do a cash out refi on that.
Mm-hmm.
But since I'm not using a community bank, I have too many. If I want to use conventional sourcing, what I should do then, what I'm hearing from you is enter into a purchase and sale agreement between the LLC and myself to buy the property.
Right. It would have to be an S or a C corp. The LLC wouldn't work. They're considered you owning it.
So consider you own it.
Yeah,
so it had to be an LLC taxed as an S corp or C corp.
I have not ventured into that. I would have to get back to you on that one. Yeah.
All right.
Yeah.
So let's just make it simpler.
Yeah.
So let's say it's in an S corp, which is not uncommon. I mean, I run into people all the time who have appreciated real estate in S corporations. So let's say I wanted to do this, and I took a piece of property and I set up an S corporation and I moved it into the S corporation on March 1st. On June 1st, I enter into a purchase and sale agreement to buy that property from my corporation. So I'm going to buy it back.
Well, that wouldn't work because you moved it in. So the title has to be bought in the S Corp or SC Corp's name originally, with funds that were from the S or C Corp, and then a purchase from the S or C Corp would be possible, which in essence is a cash out, since the entity would net the money, which is your entity. So it's a workaround for a cash out.
But that means, what you're saying is that the property would originally had to have been purchased in the S corp. How do they determine that?
They pull up the title records, the 24-month chain of title. So that's how they'll know if you've owned it or who's owned it.
Oh, so it's a 2-year. So if I was contemplating doing this, then I have to be thinking long-term down the road.
Yeah. Much of the conventional lending, we really want to plan it at least 1 to 2 years out, projecting into the future, because what you make in 13 and 14 will affect you in 15. And what you make in 15 and 16 is going to affect you in 17. So we want to make sure we plan all that out to the best of our ability. Obviously, no one has a crystal ball.
Okay. But what I am hearing, though, if I have property trapped in my corporation that I want to get out of there, one way to do it would be to sell it to myself. So if I had an S corporation or a C corporation that had property in it, I would sell it to myself, and then I would go to a lender and ask them to refi that property, refi that loan.
Well, if you sell it to yourself, right?
Mhm.
So you have a new note. You could refinance it again if you want. Are you saying you'd refinance it just to save money,
I
or
would refinance to save money, refinance just to get the cash out of the property.
oh, when it's back in your personal name?
Yeah.
Oh no, if it's in your personal name, you're still subject to no cash out.
Oh, but how about
But
if
you
I sold it to myself, or my corporation sold it to me?
correct, you can do that.
Then I could do it, right?
Right,
Yeah. So then I could refinance the property to cash out my corporation's note. Now I owe the commercial lender
right.
under
The
that.
lender convert. Yeah, it'd be a conventional loan, so 30-year fixed, most likely 20 to 25% down.
Okay. But if I already have the equity in the property, will that work, or will I still have to come up with the 25% down?
You'll have to have it from your own funds, not in the S corp. You can't use the S corp's funds to do the 25%. So that the borrower I had in my situation, he did ask that as well. So that wasn't. Luckily, he had money in a line of credit in one of his properties. He just wired 25% in, and the loan came in for the other 75%, and the transaction closed with all the money going to the S corp.
Which is important here for everybody to understand is that you're bringing 25, you're moving it from one pocket to the next. So 25,000 is going back to your corporation. You still have the money. You just have to pull it from a different source in order to make the deal come together.
Right, right. So in my case, the borrower had the property at 125 cost basis. So he didn't want to sell it beyond 125, even though the property was worth 250s. He wanted to make sure there was no taxable gain in his entity. So he sold it at cost to himself. So that's the way. He still got a loan. He didn't get as much loan as he wanted. However, it was great for him because there was limited to no tax.
How about if I went to a lender with a pool of properties? Say I had 8 properties and I want to cross collateralize them. What's your do you have any experience doing that?
I don't do them personally at New American Funding. However, I do work on a referral basis with local lenders, and the local community lenders or business banks will typically be the type of conduit that you would find a blanket or cross collateral, or even a private lender. They'll consider that as well.
Okay. And for those of you that are listening and you're not familiar with that term, essentially what you're doing is you're taking all of your properties and you're giving them as collateral for a blanket loan over all 8 is in my example. So let's say you had 8 properties and you had a total of $600,000 in equity throughout those 8 properties. What you're doing is you're borrowing, say, $500,000, and you're giving that lender a secured interest for $500,000 in each property. So they'd actually file a deed of trust against each property for $500,000 for the amount of the money you borrow, which is a great asset protection strategy, because now when you look at the property individually, they're all underwater because they have this huge loan that's been filed against them via the deed of trust. And so collectively, yes, they have value, but independently, they do not. And the benefit for you is that, of course, if you're not owning them all together in one entity, and they're not in all or in your own name, they're not an attractive target. Nobody's going to go after them. And one of the things that I often recommend people do when they're doing this strategy is to ensure they have the right in that loan agreement for substitution of collateral, so they can sell one property and then substitute the new property in exchange for the property they sold, rather than having to pay off that full $500,000 note on the sale, because the bank has that secured deed of trust there. All right, good stuff. Moving on. 10 property limit. Yeah. Why?
Back in the day, I mean, I would say back in 2009, it went back down to 4. During the financial crisis, and Fannie Mae felt, I think, that was too restrictive, so they did go back up to 10, and it is 10 per social security number, or 10 per borrower. So if you do have a husband and wife, you could potentially get 10 for each, depending on how you structure your transactions. You have to buy them completely separate, financing and title separate. So that's one way you can get more than 10. However, I don't know exactly why they made 10 as the limit. They felt that was the amount they're willing to extend per borrower.
Now, you said that was Fannie Mae, but how about if I want to use a community bank and they're going to treat it as a portfolio loan?
Well, since they're holding the paper or the note that they're lending to you, they will do as many as they please, depending on the bank. I've seen unlimited. Some banks have a limit per borrower, a couple million. Some, depending on your net worth and your your financial profile will lend you even more. Depends.
Okay. Do you recommend that people establish relationships like that with community banks?
I definitely do, because the community lenders will give you a great exit strategy in case things don't go as planned with your conventional or your private lenders. It gives you all these extra avenues.
Okay. So let's then talk about the individual who we have one income earner or primary income earner in a family. And we're up against this ceiling of 10. So it starts off that I'm looking to buy properties, and I assume that you're going to want to set this up ahead of time, because if you went in, like if I went in tomorrow and I wanted to buy a house here in Washington, community property state, more than likely not, the lender's going to say, all right, we want both you and your wife on the loan.
Correct.
So if they require, she and I both go on loan. So Tracy and I are in the loans, and then we buy 4 other rental properties, and now we have 5 properties. And I decide after listening to this call, webinar, that, you know what, I want my wife off.
Right.
And so if I take her off title, does that solve this 10 property problem now? So she could go out and get 10 properties and I could get another 5? Or would they look at that and say, well, on the loan, they required her to originally sign on that loan, therefore she's capped?
It's based on the legal ownership and debt obligation, either or. So if she's on loan but not on title, it still counts. If she's on title but not on loan, it still counts. So she has to be separate, 5 separate properties. So either you can pay off those notes, or you can refinance purely into her name or your name to separate, so each person can have up to 10.
Okay, so you have to be thinking ahead when you're doing this.
Definitely.
With the loans. So is it a good idea then to, if you're an active real estate investor, to buy the properties in one spouse's name initially?
There's one aspect financially, yes, from a qualifying perspective. The other aspect is the trust and the relationship aspect. I won't comment on that.
Oh yeah, my wife says whatever I own is hers and whatever she has is negotiable, but which means I get nothing.
Right. You could always give her 10 properties for her shopping list.
Yeah, we don't want to go there. Yeah, actually my wife lost her credit cards a couple months ago, and they were stolen. And she started complaining because I didn't call the credit card company. She goes, somebody's out there using my cards. And I said, yeah, it's a good thing. They're spending less than you, so I'm going to keep this rolling for a while. So we have
That's awesome.
10 property deals here. How about this scenario? I've been buying the properties, and they've been in my name. And so I've got my 10. And now my wife, who has the hardest job in the world, and that is taking care of our kids, we decide that, we're going to buy some properties in her name. So she hasn't been working. The problem is she has no income. So how does she qualify?
There are a couple of ways you can go around that, that I've worked with investors in the past that have asked me the same question. So there are ways to get income sources for the other spouse that don't require as much time. The quickest one I can think off the top of my mind is by either deeding a free and clear property to her, because with Fannie Mae, you can use rental income or conventional financing. You can use rental income right away. There's no need for 2 years tax returns to show that you've been, renting property. That's typically what banks require, this 2-year track record history. But with Fannie Mae, you can instantly deed her a property. Let's say it was free and clear. It was making $1,000 after all mortgage payments. So it would look like she basically has $1,000 now. That's one way to do it. The other methods are by giving her a note where she receives interest. So she could have a note. But the problem with a note is you have to receive income for a period of time, most notably 12 months, before you can even use the income. So that's a slower method. I like the rental properties because the income can be used right away.
Okay. So if I deeded her a property that I own, but it's not paid off, so I still continue to pay the debt, but I give her all the income from the property, so she's the owner.
Yeah. In that case, we would use the net. So as long as the income is higher than the obligation on the property, she would still receive a net income to her qualifying. So it would help her out.
But would it count against her 10 limit, though?
It would, and yours, because you're tied on the loan.
Yeah, so actually that wouldn't be a good idea, because then it's tying both of our hands. So paid off properties are better. Yeah,
in that example, the paid off property would be the best. However, you might do that so that she can get enough income to refinance you off. So there might be an objective to that. So for instance, you would deed her the property, the loan's still in your name, but now she has a positive income, let's say $200-300, and she could refinance that property. Has the necessary reserves in the bank. She could refinance that property.
Okay, so with the loan again, if she shows interest income, it's got to show up on a tax return?
Correct. Yeah.
All right, so we have to see that on the tax return. Then that's income we're paying tax on. So one way to do this, I guess, would be if I had a business set up, let's say a C corporation. I had her loan money to my C corporation. Then my C corporation starts paying her an interest income on the money it's generating from the use of those funds. Let's say it goes out and buys a piece of property. With that money, it's generating income. It's turning around and then paying her back on that note. Then I do it for a year?
Yes, it would be a year unless there was your name on the entity. If they, if the underwriter realized it was a family entity or a related party, then they would probably require 2 years. That's a gray area, but most likely it could be 12 or 24, depending, 12 months or 24 months, depending on how the facts sway.
So, which is a great reason why you should use a Nevada entity where your information doesn't appear on it. So
right.
It wouldn't be, well, all right. How about if you don't have income? Let's say you have assets.
Right.
Say here I am, I want to get into real estate and I have $600,000 in cash and securities in the bank. Let's just say stocks, because I have people that want to switch from stocks sometimes over into real estate. But I don't want to sell my stock because if I sold my stock, then I have to pay taxes. Do they have any loan programs where you can look at a person's assets and enable them to qualify for a loan?
There are programs out there by portfolio lenders. Fannie Mae's has actually an asset, they call it asset utilization or depletion. And in essence is basically taking a lump sum of cash or assets you have and turning it into a stream of income for the purposes of qualifying. Now, Fannie Mae's stance is they can use it from a retirement perspective. So if you're 59 and a half and let's say you got an IRA and it's 500,000, there's a formula where you can use that lump sum of money and derive a stream of income off it. It doesn't mean it's actually giving you income. It just means we're able to use a preset number as qualifying income based on the 500,000 sitting in a stock account, for instance. But back to your point, Clint, there are programs from portfolio lenders out there from smaller banks that will do this as well for investment properties and the other.
Okay, so you don't necessarily. So going back to the scenario with my wife again, maybe we don't have she doesn't have the income, but if she can show the assets, like if I had a bunch of cash, we could put it in her name and then use it to qualify for some alternative loans.
Correct. Yeah, but the downside is, these loans generally have a higher rate, about 1 to 1.5 or 2% higher than the average conventional loan. And while the conventional loans being 30-year fixed, it's just, it's much lower, much more advantageous. So you kind of have to balance your objectives.
Okay, good.
At least the option's there.
Well, anything else that you've seen right now that's coming up as far as lending that real estate investors should be on the lookout for, as far as how they hold their assets or how they present their packet to underwriting, things that will sometimes trip them up?
Yeah, I always, offer a free consult to let them know how they could structure their taxes and their properties and the method they purchase them so that they can continue their qualifying power indefinitely into the future. However, my experience is that most don't usually follow all the advice, so sometimes they go off track. But for the most part, planning ahead will definitely help you keep qualifying going forward.
Are there any mistakes that you've seen, because you work with real estate investors? I mean, is there any common thread there amongst some that you see over and over again that they're doing that they should be avoiding?
Yeah, a lot of investors who do fix and flips, they'll max out their credit cards and such, and they've got to realize that by using more than 30% of your revolving credit cards can significantly drop your credit score, so that when you do come to a lender like myself, it becomes very difficult when your score has dropped from 720 to 600. So that's going to make it very difficult. I would definitely advise to watch where you're spending on your revolving lines of credit.
Okay. Now, let's say that I was in that situation and I were to pay off a good portion of the revolving line of credit. Can you do a rapid rescore and then bring that right back up? Is that possible or not?
We can do that. That takes about 5 business days, but depending on how long you have and how quickly you have to close and how good of a deal you have, you may not have the time to do that, in which case you could always use other means like private money or hard money to get it quick.
Closing in trusts. Have you noticed that banks are willing to close in grantor trusts at all, or is it pretty much they still want it to close in the individual's name?
By grantor, do you mean revocable living?
Yeah, to say land trust, but I wouldn't use the word land. I would just call it, many times when I set up a land trust, it's not obvious to the person reviewing it what it is. It's basically a grantor trust. I do not use the word land in my trust documents because so many people don't understand.
So we buried in there, right?
It doesn't say it anywhere. It just states that this trust is created. Here are the beneficiaries, and the assets are going to hold in trust for themselves.
Yes.
Is that a problem?
I've had a land trust be declined before, but they had the word land trust all over it, all throughout the verbiage. But I'd be happy to take a loan with your land trust on a ride. We'll see if that works. So, but typically, yes, you can do living trusts. You can fund in them with conventional financing or FHA.
Yeah, because I've seen it with living trusts that it seems to work better. Tax returns. We're getting close to the end here, but I just want to hit on that. Is there a perfect tax return as far as a lender's concerned, what they're looking for? I mean, how do tax returns sometimes screw up a lot?
The use of complex structures and planning on the accounting side can really hurt a return if the lender does not review it from a qualifying perspective. Sometimes people go very aggressive on the write-offs and end up not qualifying. I think there is no per se perfect tax return. From an investor standpoint, perfect would be zero tax and tons of cash coming in. But from a lending point of view, a perfect would be something that's very simple to read so that the underwriter doesn't have to fuss. Because you got to remember, these underwriters aren't tax and accounting professionals or investors. So they don't really understand all the strategies involved. Even a W-2 and profit split from an S-corp, I have constant trouble with doing loans on that. They don't understand that the W-2 is also their income and the profit split is also the borrower's income. I have to always explain why they do that.
Distributions that they're taking.
Right. I have to explain, they're trying to limit their payroll tax, so they have a smaller W-2. It's the same income.
And they're looking more at the W-2 income than they are at the distribution income.
That's correct, yeah.
Yeah, that's one of the things that, we talk about a lot is how you structure yourself. That just because you can do something a certain way doesn't necessarily mean you should do it that way.
Right.
Because there are other factors involved in buying real estate. One is obtaining loans and working with underwriting. One of the strategies that we teach a lot is to have a holding LLC, typically set up in Nevada, that owns multiple limited liability companies disregarded to that one holding company. So you can have the Nevada LLC owning 3 or 4 different limited liability companies, and that Nevada holding company is many times created to be taxed as a partnership.
Interesting.
So it produces a K-1 onto the tax return for the individual investor. And the thought process there is it reduces the risk of audit, because then you don't see all those properties on Schedule E.
Correct.
Because all they get is a K-1 from their return. Because I imagine, I've seen this myself in dealing with my own loans, is that I'm in several joint ventures, and all of those K-1s that come onto my 1040 create requests.
Oh gosh.
Yeah. Underwriting will ask, well, I want to see the tax return, 2 years of tax returns for this entity and for that entity. And then they want to see K-1s. They want to see the K-1s kill me. Balance sheets, profit and loss statements, bank balances.
First newborn.
Basically, yeah. And it's frustrating, especially if you shut down entities, because some of the strategies that we utilize is, you do some properties, flip a few, and then you shut the entity down after a year. But it still shows up. Yeah,
we'll need cancellation, termination, right?
Correct. And it's one of those things, again, where you look at it from an asset protection and tax planning side, as you stated, but it will not necessarily help you on a lending side. So you have
Correct.
to be sensitive to both
Mm-hmm.
when you're a real estate investor. And so you work, as you stated, in 4 different states.
Correct. Not physically. Now I'm back and forth between Washington and Orange County. So we have an office here in off Dock Street in Tacoma, and I also have an office over in Tustin, Orange County. So we go back and forth.
So if somebody wanted to, that's on this webinar right now, if they wanted to get a hold of you and ask you some questions or maybe get some assistance in putting loans together, how would they go about doing that?
You can reach me at my number directly. It's 253-254-7051, or my other number at 949-514-5106. Or you can reach me at my email. It's albert@albertbui, that's BUI.com.
Okay, so just your name right there that we see up on the screen.
Yeah.
Excellent. So you're open to taking calls from investors, answer their questions, and
Yeah, I love investors, self-employed, anyone looking to use any form of advanced planning. I always enjoy learning about it, so I love helping people with those scenarios.
How about if I don't live in one of the states that you mentioned?
With the other states, while I may not be licensed, there are some people on my team who are licensed, which we could work together from a planning perspective, but they would be the licensed loan officer on your transaction.
Okay. So it's a great resource. Having access to money is important, especially as you're a real estate investor, and you never know what the government's going to do when it comes to changing the loan standards and criteria for banks. And so working, I think, with a banker that is also a real estate investor is so very important, because not all loan officers understand the investor mindset. And I think that's,
Right.
What originally when we first started talking, that struck me about you is that, I've seen you around at real estate investor conferences, and you know how to talk the talk. Whereas when you're dealing with an inexperienced loan officer who, typically deals with the individuals coming in to buy themselves or their first primary residence, they don't understand what you're doing.
Yeah, I noticed that most loan officers, while being very smart and great people, they're not focused on the real estate investor or how to read those complex returns or scenarios, or understands the mindset of what the investor is really looking for at the end of the day. So it really helps when being in the the real estate investment game day to day to be able to look at it from multiple viewpoints, or even the business owner's viewpoint. They have different perspectives than the real estate investor or the loan officer. Because most loan officers, we're working with first-time buyers or second home buyers, which is a typical scenario. And the much needed niche of self-employment and real estate investors is where I find that it's most enjoyable.
Yeah, and I can't impress upon the listeners enough about this particular issue is that you want somebody who is going to coordinate that loan for you and deal with that loan officer and explain to them what you're trying to accomplish and why your returns look a certain way. And as you stated, that W-2 income and distributions, it's all income to the individual. They just chose to save on employment taxes.
Right.
I've been in that situation too many times where the loan officer isn't helping me. And all they're doing is just kicking the questions back that the underwriter's asking and telling me to answer those questions. And it gets frustrating because I've got my life. I'm trying to do other things, and I would expect that the loan officer would field many of these and deal with it for me.
Yeah, and I see it. Sometimes I'm able to intercept these potential issues ahead of time so that the borrower never even feels the issue of decline or whatever, the file getting suspended. Sometimes it's just a letter of explanation and structuring the file correctly, and it could be a breeze. But if we're not able to structure the file correctly, it could be a nightmare doing a loan.
All right. Well, I want to thank you for coming on down to our office this evening and sharing this valuable information with our real estate investor clients. I know that they got something out of this. I learned a few things as well just from talking to you that I hadn't known, and it's helping me going forwards and putting my own loans together. And of course, I'm going to be using you as well. So that works. And like I said, if anybody had any questions, they can give you a shout, and you can hopefully help them out and obtain their loans.
Yeah, I'd love to talk, and I really appreciate your having me on the show, and take care.
Can you give me your phone number one more time?
Sure. It's 253-254 514-7051, or my other number is 949 for Orange County, 514-5106.
And your email?
It's albert@albertbui.com.
All right. All right, everyone. Hope you have a good evening, and we'll catch you on our next webinar.
Take care. Bye.
Bye-bye.